Assalamu alaikum. Good morning, everyone, and thank you for being with us today. And I would like to thank MSX for the arrangement. And first of all, I would like to introduce my colleagues. I'm joined here with, on my right, the Chief Financial Officer, Mr. Craig, and on my left, Mr. Majid Al-Busaidi, who is our Chief Risk Officer. I'll make my remarks relatively short to allow more time for Q&A. And I would like to start first with the recent S&P revision of the outlook for Oman, which they have revised the outlook from stable to positive. And that revision, we believe, is a reflection on an optimistic view on Oman's economic prospects and fiscal management. Over the years, we have seen Oman has actually emerged from macroeconomic vulnerability with strong economic fundamentals, and economic growth has been robust, driven by the recovery of both hydrocarbon and non-hydrocarbon sectors. Inflation also has been managed and maintained at moderate levels, relatively speaking. The fiscal and external balances have been comfortable. They've been in comfortable surpluses since 2022, and public debt has been significantly reduced year on year. It's also great to see the government efforts intensifying to further reduce the dependence on hydrocarbon revenue and promote strong and inclusive and private sector-driven non-hydrocarbon growth. So it is also encouraging to see increasing private sector participation through privatization initiatives and public-private partnerships that will actually help stimulate economic growth and create job opportunities. The government drive to enhance business environment by improving the ease of doing business is also encouraging, and this will also help to attract more investments and support growth, which eventually will also support to advance Oman economic diversification agenda. So overall, Oman diversification strategies in tourism, in logistics, manufacturing, mining, and minerals and fisheries aim to systematically reduce dependence on oil revenues and stimulate economic growth, create job opportunities, and enhance the country's competitiveness. And also by attracting foreign investments and promoting these key sectors, Oman is on track to build a more resilient and diversified economy for sustainable development. On the budget side, the 2024 budget has been meticulously crafted to achieve a number of economic and social objectives, and this will deliver, as per the projection, approximately 3% growth and continue to maintain the inflation at moderate levels. So on Sohar International, our vision has been consistent right from the beginning of our transformation journey in 2018 to be a world-leading Omani service company that helps customers, communities, and people to prosper and grow. And this vision is underpinned by four key foundational pillars. The pillar number one is purpose. We help people win. The pillar number two is promise, delivering banking services responsibly and responsively. And also the pillar number three is principles, the principles of more vision, more value, more velocity. And the last pillar is the personality, being sharp, being human, and being unstoppable. This has been reflected overall on our brand positioning and the whole drive over the last 5 years in the way we have steered the growth of the bank to become what it is today. The strategy is underpinned by four key pillars as well. The first one is to reimagine the business of banking. We have studied the market, we've looked at the trends, and we want to make sure that we always remain relevant and resilient in our business. We also reevaluate value chains. That is pillar number 2, and reconnect with our customers and continue to rebuild the organization, something that we'll be discussing over the next coming slides. So this is how Sohar International today looks like. We are owned 67% by government, quasi-government institutions, and 23% by private institutions, and others 10%. So we maintain a very strong ownership structure, and we are present across the country with a wide network of 85 branches that are actually complemented with extensive digital touch points. We are serving over 520,000 customers, and we have grown quite substantially due to the merger. That's something that we'll be discussing shortly. And also we are celebrating the opening of our first branch in Saudi Arabia, Riyadh. That is our first ever branch overseas, and that just reflects on the strength and the resilience that we have built in our overall business, and that the strategies are actually working. And also these numbers and all of these achievements have been also due to the successful merger with the H-Bond, HSBC Oman. That was actually executed professionally and seamlessly, and we're going to talk a bit about that in the coming slides. But today, we are the fastest growing bank in Oman. We are the second largest bank in Oman, and we have approximately $1.7 billion of market cap, $1.7 billion of market cap, among the top ranked in ROE across the GCC. So it's important, we thought, to look at the time horizon. Historically, the last 5 years, how the last 5 years have actually evolved for us, and what kind of resilience and capabilities we've built in our overall business to ensure that we are able to sustain as we go forward. And at the same time, we are able to navigate through ever-changing operating environment. As you can see, first, financially, we have built on the liability side, a strong deposit base, and with a substantial amount of low-cost deposits, and we've grown our assets quite substantially. And as you can see, our profitability has more than doubled over the last 5 years. But in the meantime, as I said, because we want to make sure that we remain resilient and relevant, we have also established a strong corporate governance and risk management frameworks over the last 5 years, a strong ownership structure with very competent board of directors and experienced management team. And also we have been able to develop a strong brand and corporate franchise, and invested heavily in technology with the cutting-edge digital capabilities and robust technological platforms. And also we have repositioned completely our balance sheet, which is well now capitalized to support our growth plans with very strong liquidity buffers and funding base. We're going to see that over the coming slides. And we have delivered a very strong, solid growth and resilient financial performance over the last 5 years, as you can see on the numbers. And we have very clear growth plan in place. We continue to tweak it year by year as we perform, and this is just to give you a sense on the governance structure and the risk management framework that we actually observe within as an institution. And we also have developed a framework for ESG to make sure that we are committed, we are conforming to the best practices. Our desire to grow internationally also brings a requirement for us to make sure that we remain committed to enable positive social, environmental, and economic impact and change, supporting our stakeholders to prosper and grow. This is the framework on our ESG, which is under implementation. There is a number of initiatives under each of these three pillars of the framework, which are under implementation. And with that, I want to take you to the financial review, just very high level, and I'll leave to my colleague, the Chief Financial Officer, to take you through the details of the financials. As you can see, the way we have repositioned, if you recollect the history, where we have been, where we are today, the earnings and profitability have scaled up quite impressively. The credit quality, also, we've been very prudent, very responsible in our approach to deal with this particular aspect of our business. The capitalization also, we have maintained good capital levels to support our growth. Funding and liquidity, as you can see, the loan to deposit ratio stands at 77. We're the most liquid bank today. When it comes to the low cost deposit as a percentage of total deposits at 70%, again, that is the highest in the market. And overall, the balance sheet strength has improved year on year, and the merger also has further accelerated our plans for growth and profitability. With that, I would like to let my colleague Craig to take you through the detailed financial performance under different matrices. Craig, over to you.
Thank you very much, Ahmed, for that introduction regarding the financial results. The financial results for 31 December reflect 4.5 months of the results of the combined, or the merger between HSBC Oman and Sohar International. The merger was resulted in the net assets of HSBC Oman being consolidated with the results, the balance sheet of Sohar International. The profit for the year, therefore, reflects that 4.5 months profitability. So we saw a 102% increase in profit for the year. Return on equity was 11.1, greater than 10%. Net loans and advances are up 34%. Asset quality improved down to 4.8%. Coverage ratio is at 143%, which is the highest in the market. The capital ratios reduced from prior year, but that was due to the fact the bank had positioned itself to complete the merger activities. As Ahmed has mentioned, the positive credit ratings for the government of Oman have also reflected it in the positive credit ratings for Sohar International, and those continue to improve, and they're currently stable. If we look at the
from there.
Yeah, sure.
The clicker.
Thank you. Yes. So if you look at the profitability components, what you can see there is in terms of the overall 11% increase in the operating income, the sources of that income has come from the net interest income, 25%, and also the non-interest income, which is 23%. So very diversified sources of income for the bank. We booked a gain on bargain purchase in relation to the merger with HSBC Oman, and we also were very prudent in providing management overlays to increase the loan impairments provisions for the bank to strengthen the balance sheet. If we look at the if we look at the balance sheet structure, the balance sheet size has grown by 62%, which was pretty much entirely as a result of the merger with HSBC. In particular, on the balance sheet size, we saw a large increase in cash and convertible securities. And on the liability side, we saw a very significant growth organically by Sohar International around the deposit raising. On the credit quality, as I've mentioned, the non-performing loan ratio has dropped to 4.8%. Coverage is up at 143% from 89% in 2022. And the cost of risk reflects the prudence, which I referred to earlier. On the capital ratios, as mentioned, our ratios are very healthy, well above the regulatory minimums, and it positions the bank very well for future growth opportunities. The funding and liquidity, as mentioned, the CASA ratio is the strongest in the market. This supports the bank's cost of funds and therefore supports the underlying bank's profitability. The liquidity coverage ratio, net stable funding ratios are extremely strong, thereby reflecting the results of the bank's initiatives around increasing its CASA. The net loans to deposit ratio has dropped from 114% to 77%, and again provides the bank with great opportunity to support further growth opportunities and initiatives within the Oman market as well as our international operations. And that's all I have.
That's it. Thank you. Thank you, Craig. As I said during my opening remarks, will be relatively short to allow more time for the Q&A. Now the floor is open for your questions. You'd like to mention something before?
I think we will take the questions by raise of hand for the team to
Yes,
be able to manage
exactly.
this. If you don't mind.
So whoever has got a question, please raise your hand, and we will accordingly allow everyone. Everyone will have a chance to ask. You don't have to worry, but please raise your hand. We can see there. Any question? We can see someone there. Joyce, yeah. Matthew.
Good morning, gentlemen. This is Joyce Matthew from United Securities.
Hi, good morning, Matthew.
Congratulations on the successful completion of the merger and a good set of numbers. A few queries that I have is on your outlook, future outlook for loan book growth. Now that you got up a very stable deposit base, you have your liquidity ratios have improved. So what's your strategy for loan book growth, and what's your outlook for the next 1 year or 2 years?
Okay, obviously, as you know, I can't give you the specifics given that we are listed a company, but overall, we are optimistic on the outlook. And you can see even the rating agencies are changing their view of, we've seen the first one is S&P from stable to positive. So the outlook actually is very positive. And we see activities all across all sectors of the economy, and the government efforts to diversify the economy and reduce dependence on oil and gas. I think that is very encouraging. We can see opportunities in every sector: mining, manufacturing, tourism, fisheries. So we can see opportunities across all these energy, all these sectors. So we are very optimistic, and we are pretty much aligned with the government drive in economic diversification, and will play a catalyst role in making sure that we help to advance Oman economic diversification agenda. As you can see, our balance sheet is well positioned for that. Our liquidity and funding are well placed to support our loan growth. Capital buffers are good enough, and we have a very strong shareholding structure that are very committed, and they proved that right from the beginning of our journey, that for every growth opportunity, they are very committed to support the bank and capital in order to grow. So we are very grateful for that, and we are very optimistic going forward.
Okay, thank you. On your ECL provisions this year, you have booked a very huge ECL provisions of around 105 million riyals, and that's almost equal to the cumulative provisions that you have booked over the previous 3 years. So could you throw some light on this, and how do you see the provisions going forward?
I will let my my colleagues, the Chief Risk Officer and the Chief Financial Officer, to shed more lights on this. But at the high level, well, our approach is being prudent and being responsible to build a very resilient business. And therefore, all these decisions we make and choices we make are designed to support that kind of philosophy. But I will let my colleagues shed more lights on that as well. Abu Ahmed, Craig, want to shed some more lights on this?
Yeah, just to kick off on that, we've included in our loan impairment charges a significant element of management overlay. This is in line with our adoption of a prudent and proactive approach when we consider various impacts that are in the market, lag effects of interest rates on borrowers, global, regional, geopolitical issues. So we take a whole holistic view of that management overlay. So we apply internal expert judgment in relation to evolving credit risks, which may not be reflected within the standard credit models which we adopt and which are common obviously across all the banks under IFRS. So this was really the bank positioning itself to again strengthen the balance sheet. And it should be noted that, again, our coverage ratio was at 89% in 2022. It's now at 143%, which is actually slightly higher and not out of line with Oman's largest bank, who run a very similar percentage, maybe for different reasons, but this reflects, again, the prudence in our strengthening the balance sheet and being conscious of the risk that may be contained within portfolios.
Just to add to what my colleague Craig mentioned, and as I emphasized in our public financial disclosures this time around and previously as well, the bank maintains a very prudent approach towards risk-taking through a well-defined risk appetite framework that is further supplemented by a comprehensive set of risk management policies. And what you are looking at is nothing but a reflection of that prudent and proactive approach towards risk management. And this is not something that is unique to this financial year. It is something that we have demonstrated consistently over the past few years. And it's also a reflection of our unwavering commitment towards building long-term resilience and sustainability in the system.
Okay, but I'm seeing when I look at the different stages of your loans, I'm seeing almost 4% of your total loans has been transferred from stage 1 to stage 2. That's around 175 million, and you have taken a provision of on 50% of that. So I'm just wondering whether there would be additional provisions on this exposure because you have taken 50%. Will there be additional 10% every year that will come into the that will be booked over the in the future? So and if you are taking that 10%, that's 17 million, which is again at an elevated level, and your cost of risk is likely to remain elevated even after you got one of the best books that the country had, HSBC books, and now still. It looks to me that you still are facing issues with the asset quality. So that's just what I wanted to clarify that and take your views on that. So that's the reason why I asked this question.
So the comparison year on year may not be the best approach here because you are actually looking at two balance sheets that are being consolidated, and that's why it is not really apple to apple. Straightforward comparison may not be the right comparison. But if you are to look at our position in relation to the market averages, then you will have a much better understanding of the overall positions. be it the MPAs or the coverage there too, we are not far off from the market. Actually, it's just within that, but slightly higher on the coverage side, which is again something that is being done on purpose to ensure that we as resilient as we should be.
Okay. And the other question that I have is on your deposits. Could you share some thoughts on your deposit for strategy for deposit mobilization, especially after the merger? You have the best CASA ratio, which you've just mentioned. But this 70% CASA ratio, would it be sustainable, or what would be the ideal level that you would be very comfortable with?
Okay, Craig will give you a lot more details on this, but to tell you strategically for us, we want to maintain a good amount of CASA as part of the overall deposit base, simply because we need to make sure that we build the pricing competitiveness in our balance sheet, and anything about 50%, that is our goal. Now, are we going to maintain the 70%? The answer is not really, because that number could fluctuate, but will definitely be above 50%. Because as the base is growing, the percentage may come down, but the quantum will grow in value. And therefore, you will see the overall blended cost of fund that we are trying to maintain is at the level that gives us the competitiveness in pricing, and that is the way forward. And also at the same time, we are building the CASA base, which is a lot more sticky and long-term. It's not something that is volatile and causes a lot of disruptions within the overall business. So you will see the stability and the stickiness of this deposit base as we go forward. But even if we are not to increase the CASA base today, but we are to increase the overall base of the deposits, you will see that percentage slightly coming down. But 50 to 60 to 70%, I think, is the good level to be.
That's right. Just to add to what Ahmed has just mentioned, I mean, the CASA contains three components in Oman's current savings and core. Current savings are low cost. You've seen a very significant increase in the bank's savings accounts from 507 million in 2022 to 840 million. The core component has increased to an extent by design. With the expected falling interest rates, the bank has been constantly looking at using call accounts rather than locking in long-term rates. And that gives us the ability to reprice and reposition the funding of the balance sheet. So that is also reflected in the numbers. It is dynamic. And we look at holistically how we fund the bank through various mediums, and core deposits is one, which may reflect in some of that increase. So that may not stay at that level. As interest rates fall, we may look to lock in more term deposits.
One more question, if I may. Could you throw some light on the status of your Saudi operations and your future strategy there?
Okay, so it has just opened for business now. We have got 75% of the team in place. The 25% will be completed post-Eid, and it's very well located. I invite you to visit our branch once you have visited Saudi Arabia. It will be great to see where we are in the center of Riyadh, and we are open for business. Now, what is going to be the focus? Predominantly will be to actually focus on the Oman-Saudi trade and investment corridor. We want to facilitate all the trade and investment flows between the two markets. There is a lot of potential we see and activities in this corridor, and I think it's just the right thing for us to do. And apart from participating in local opportunities, it's a growing economy. It's a much big economy, and therefore we are very proud to have our presence there, and we have got a very good team in place to actually deliver on our strategy.
Okay, thank you for answering the questions. I have a few more, but I'm seeing more hands raised. So I'll take my position back in the queue.
Okay, right. Thank you, Matthew. Any other question?
Yes, hi. This is Nitika Gupta from Mobile Capital. Can you hear me?
Right.
Yes, hi. So congratulations on the completion of merger, as my colleague also
Thank you.
mentioned. So I had first, I have a quick clarification. So this gain on bargain purchase that was included in Q3 and Q4, is it likely to be repeated in Q1 and Q2 for 2024 until 1 year of it is completed or of the merger, or is it done? I mean, is this one-off element completed? I'm just asking for modeling purposes.
Yeah, sure. The bank has the opportunity, as you know, to 12 months from the date of acquisition, August 17th, to review the entire portfolio. There is still activities ongoing in looking at another certain aspect of the assets acquired, but we certainly don't expect a number anywhere near the magnitude of what we've seen. So we're just going to complete that exercise based on a certain part of our portfolio, which we think is worth looking at to see if there's any other value that can be created there for the bank and the shareholders.
Okay, sure. Understood. Thanks. And secondly, on the cost to income ratio, how do you see it panning out, this year and eventually? I mean, this year I can understand if it is heightened, but eventually, what is your target, level that you're looking to bring the cost to income ratio for the entire bank?
Without giving any forward-looking comment, the results for the year include obviously some one-off costs in relation to the acquisition. And if we look at where the bank is heading in terms of merging with the staff, our technology, we would expect that cost-income ratio to stay relatively flat to down. The bank is continuing to invest in people. We're continuing to invest in technology, and we have a strategic growth agenda. So all of those aspects will lead to pressures on the expense base, but conversely, we have the gains that we'll achieve on the income side. So we would expect to be having a downward trend on the cost-income ratio rather than upward trend. But we can't give any specifics around that ratio at this stage.
Okay, thanks. That's good color. And just one last one. So going back to the question of loan book growth. So now we understand that the loan book itself is
Going back
quite
to the
big.
question of?
Repeat the question, please.
Loan book growth. Loan book growth. Can you hear me?
Yes.
Yes.
Yes. So we understand the loan book has grown significantly after this merger. So a mid-single digit growth, a little above what Oman is growing at, would it be a fair assumption to make in the medium to long term? Or we could be aiming higher for that mid-single digit growth in the loan book, because this is what helps us to model the valuations and everything. So just trying to understand from that perspective, because it's a big bank now. It's not it's not a small bank that we can keep growing at double-digit percentages. So what is likely, it's mid to high single digit or mid-single digit is what you're comfortable with?
Without any specifics, Nitika, we are a growing organization. Our focus is scaling up growth with excellence. And we are pretty much aligned with the government initiatives when it comes to growth. And therefore, when it comes to the percentages of growth, you should see us growing in line with the market or slightly above the market rates. So that is the kind of approach we maintain.
Okay, quite helpful. Thank you. That's it from me. Thanks.
Thank you.
Thank you.
Any other question? We see there Mr. Bala of Balia.
Hello.
Hello, good morning.
Hi, very good morning, team. This is Vishen Bhala from Vision Capital. I just wanted to get your views on how you see the risk in the economy, given how the situation has improved over the last couple of years, stable oil prices, ratings upgrade. Now we try and sort of tag that with or link that to gross NPL levels, provision coverage ratio, restructured loans as a percentage. And we can clearly see Sohar has done exceedingly well on all three parameters. Gross NPL is in line with the sector. Provision coverage is on the higher side with the market leader. Restructured loan book is among the lowest, if not the lowest in the sector. So how do you see sort of what kind of discussions are you having with your clients over the last quarter as compared to, let's say, 12 or 15 months ago? If you could just give us some color on that to understand how you perceive the risk in the economy compared to, let's say, a year ago.
Okay, on the conversations or the discussions we have with various clients, actually there is a sense of optimism because the economic fundamentals have actually improved. You can see the fiscal position of the government is very good now, relatively speaking, compared to the past. The debt to GDP is on the way down, and there is a lot of investment across all sectors of the economy. And the introduction of the future fund of about $5 billion of investments that will be injected into the economy is very encouraging. So I think many companies are looking around on how to position and seize these opportunities, large, medium, and small as well. So we are optimistic about the domestic loan growth, credit growth overall, because the fundamentals have improved. Now, how are we looking at the outlook on the overall, given the geopolitical developments? We are very cautious, cautiously optimistic, and that's why you see in our strategies the coverage ratio on the NPL is on the higher side, simply because we are factoring or pricing in all of these factors like what Craig has explained to you to make sure that we remain resilient and steadily performing without causing any volatility in the numbers going forward.
Okay, noted. Second is with regards to sort of if I split up CASA, we talk about CASA and you have the best CASA in the banking sector. And if I look at just savings as a percentage of deposit, because that is the actual sticky amount, now that is sort of in line or slightly lower than the sector average. What sort of discussions you've had with the depositor base over the last, let's say, 6 to 9 months, given the rise in interest rates, and how do you see that panning out over the next, let's say, 2 or 3 quarters?
Over the next 2-3 quarters, we really don't expect any significant change on this, simply because the expectations on the rate cuts are on the high side. Everybody expects at least Q3, Q4, there should be some sort of rate cuts. And therefore, if that is the case, you'll see the overall interest rate environment somehow is subsiding. And therefore, the CASA in particular, if today we can maintain at that level, you should expect the same level, if not more, over the coming quarters.
Okay. And all right. And when do you see this when do you see the actual, in terms of, now I'm going to talk about the merger, sort of what kind of synergies do you expect from this merger on the cost side and in general, and what sort of time frame do you have as a goalpost internally?
Actually, we have done that already, and you might have seen, if you're looking very curiously at our financials, we have already realized quite a number of synergies. First of all, on rationalizing the different cost items that Craig may give you the details. But what still we are yet to do, for example, is rationalizing the branch network. Today, we have duplicate branches in different locations. We are rationalizing the branch network to make sure that we have an optimal structure of our distribution channels that are complemented with our digital touch points. And I think the synergies will continue to benefit from over the coming quarters, but so far we have been able to realize quite a number of benefits. Great.
Yeah, thank you. I mean, we are seeing synergies. I mentioned earlier about the cost income ratio, which we believe will have some downward pressure. We during the merger, it was extremely successful. We did not acquire or take on any HSBC legacy systems, none. This was entirely generated systems internally. It was a very smooth merger of databases, and that's very powerful. Also, we're able to absorb a lot of services in-house within the organization, which are otherwise provided to HSBC offshore. So we've managed to absorb many of those functions without the level of staff increase. So we've already realized synergies from that merger, and those synergies will flow through to this year as part of the full year results. So we see very positive benefits from the merger from a cost-based perspective, and that's a very important aspect of it.
And also, just to add, it also allowed a faster and accelerated realization of all the technological investments in which the bank has been focusing on over the past few years. Given the fact that we have not acquired, as mentioned by my colleague Craig, any of the HSBC proprietary solutions. We used our own, and our own were sophisticated enough to accommodate the larger balance sheet that has increased by 60%.
As well as the products.
Yeah, and apart from the cost synergies, the revenue synergies as well, the funding and liquidity, there's been a lot of synergies there that we've realized that complementing our balance sheet. And when you looked at their balance sheet and our balance sheet, we can do the math and identify the synergies. And we have identified all of those synergies, and we're working very closely to make sure that we realize the full benefits.
All right. One last question is, the disclosure you made on the 31st January with regards to the proposal for dividends versus what was approved by central bank. Now, if I look at your EPS, it was well within the amount that you sort of proposed, 7.5 paisa, and then it got revised to 5.5 paisa and 1.95% bonus shares. So if you could just give us some color as to what happened over there.
Greg, you want to take that?
So with the dividend, yes, where you looked at the 7.5 paisa per share, but in terms of the final decision from the board, we decided that 5.5 and 2.0 paisa per share would be appropriate for this year, given the performance. We can't make any forward-looking statements in relation to future dividends. But if you reflect on the payout ratios in the past, you'll see that this year's payout ratio is consistent and certainly more in line with the shareholders would expect.
Okay, because you're allowed to go up to 60. I mean, at least our fundamental understanding that you can pay out 60% of your profits as dividend.
Right.
That's what the bank intended to do this year and then revised it. So at least that's something we could sort of expect going forward is what I'm at least getting from your statement. Okay, that's interesting. All right. That's it from my side, gentlemen. Wish you all the best and thank you so much.
Thank you. Thank you very much. We have another person there raising hand.
1%. Oh, that was
Anybody else has got a question? Nice. Okay, if there are no further questions, maybe we can just say thank you very much for your time, for your questions and participation overall. And we wish you all the very best. And want to tell you Eid Mubarak in advance. Enjoy your holidays with the families and take care. Thank you very much.
Thank you.
Thank you.